our expectations, our prognosis for inflation is not that it is entirely supply driven. There's a strong rebound in demand that we've seen in many parts of the world that has also fed into commodity prices. So it's not just a supply story for commodity prices, but it's also the big recovery in demand that we have seen. And so there are the standard macro factors that have an impact on inflation, which is the amount of fiscal stimulus provided, the monetary policy stance, the behavioral reactions in the sense how quickly people have come back to spending. Those are more standard, but then you combine that with a whole bunch of non-standard features, which are very pandemic specific, which is people spending more on goods as opposed to being able to go to restaurants and so on. The fact that workers are falling sick and then they're held back from returning to work, some of them picking early retirement, which is what we're seeing in the US, and then the global supply chain and the breakdowns that we're seeing over there. So it's a complicated process to forecast the path of inflation. Our expectation is that from the second half of this year, we would see inflation coming down pretty much in all countries. But for some countries like the US, even though it comes down, it still ends the year quite a bit elevated relative to the 2% target for the Fed.
The fear always is, Gita, that some of this starts to feed into inflation expectations, and then that leads to wage price spirals and so on, and second round impacts. As things stand right now, is there any clarity on whether we are seeing that impact on expectations, at least in the US? I know local country conditions are very, very different, but in the US?
In the US, if you look at inflation expectations, you look at medium-term inflation expectations, they look well behaved, they look anchored. The very near-term inflation expectations have gone up, consistent with what we're seeing in terms of the recent inflation data. But that's, if you look at labor markets are quite tight. We are seeing nominal wages go up at a rate faster than pre-COVID. But again, overall, while there's been an increase, we're certainly not seeing a wage price spiral. We're seeing inflation wages going up particularly strongly for some workers, those that work in leisure and hospitality, less so for certain other sectors. So while overall, I would say wage inflation has picked up, and that's one of the reasons why you have much more broad-based price inflation, and which is why the US Fed will be raising interest rates. But we're not at this point in a wage price spiral or any sense in which we have de-anchored inflation expectations.
For the rest of the world, Gita, as the US Federal Reserve starts to tighten and raise interest rates, I think memories of what had happened during the taper tantrum are still very much alive and fresh. The implications for financial conditions tightening globally, particularly for emerging markets, how do you see that?
That is one of the risks that we flag in our outlook, which is that if it so happens that interest rates start rising even faster than what we expect given the US interest rates increases, or there is this excessive turbulence in markets and borrowing costs shoot up around the world, then that certainly will have an impact on many emerging and developing economies. But again, it's not one story fits all for several of them. Unlike compared to 2013, 2014 of the taper tantrum period, there are several countries that have much more foreign exchange reserves. Most of them haven't received a big surge in capital inflows. They don't rely very heavily on foreign currency borrowing. But on the other hand, there are countries that have large external financing needs, are borrowing short-term, borrowing in dollar terms, and they are particularly susceptible to this. And that's something we're watching closely.